If economic crashes are always called unexpected, why do the same warning signs appear months before they happen? Crashes don't come out of nowhere. They build slowly, like a storm, as pressure rises and small signals start to align. By the time the crisis hits the news, it's usually been forming for a long time. There's no crystal ball, but there is a real system tracking economic stress. It doesn't predict dates, it measures risk, and when enough warning lights turn on, history shows the odds of a downturn rise fast. When the economy starts to slow before anyone admits it. One of the first places economists look is at leading indicators, which are designed to move before the broader economy does. These indicators don't confirm a recession after the fact. They hint that something underneath is weakening. A key example is the Conference Board's Leading Economic Index. It blends signals from manufacturing orders, financial conditions, labor expectations, and business sentiment. When this index falls persistently, it has historically preceded economic slowdowns. In 2025, the index showed repeated declines over several months, indicating that forward-looking activity was losing momentum, even while headline numbers still looked solid. This doesn't mean an immediate crash, but it does suggest that economic growth is becoming more fragile beneath the surface. Think of it as the economy starting to walk with a slight limp while insisting everything is fine. Where fear shows up before headlines. If you want the most brutally honest economic signal, you don't ask economists. You watch the bond market. The bond market compresses millions of decisions from investors who are betting real money on the future. One of its most famous signals is the yield curve, which compares short-term and long-term interest rates. When short-term rates rise above long-term rates, the curve inverts, signaling that financial conditions are tight and growth expectations are weakening. This signal isn't magic, it's math and psychology. Investors demand higher compensation for near-term lending when they believe risks are rising, while long-term growth expectations fall. Historically, yield curve inversions have preceded nearly every modern U.S. recession. The New York Federal Reserve takes this signal seriously enough to publish a recession probability model based directly on Treasury spreads. As of late 2025, that model showed a meaningfully elevated probability of recession within the following year. The bond market doesn't predict headlines, it prices anxiety. When jobs quietly start to crack, recessions become undeniable when people start losing jobs. But the labor market often weakens before the public notices. That's why economists track a simple but powerful signal known as the SOM rule. It activates when the unemployment rate's short-term average rises noticeably above its recent low. This isn't based on forecasts or opinions. It's based on actual job losses showing up in real time. The SOM rule doesn't predict recessions years ahead. Instead, it detects when one is likely beginning or very close. Historically, when this rule triggers, the economy is already in trouble, even if official declarations come later. It's the moment when the storm stops being theoretical and you start feeling rain. The central bank models. Behind the scenes, central banks run complex macroeconomic models designed to turn incoming data into risk estimates. These models don't declare certainty, they assign probabilities. One public example is the New York Fed's DSGE model, which estimates the probability of a recession over the coming year based on growth, inflation, policy, and financial conditions. In late 2025, this model showed recession probabilities that were far from trivial, signaling that downside risks were elevated even if growth had not yet collapsed. These models matter because they aggregate dozens of signals at once. When they move sharply higher, it means many independent stress indicators are starting to agree. This is less about predicting the future and more about measuring how unstable the present has become. Why waiting for GDP is too late? Official economic data moves at the speed of paperwork. GDP numbers arrive months after the economy has already changed, and even then they're revised again and again, like a story that can't decide how it wants to end. By the time GDP officially confirms a recession, businesses have already cut spending, households have already felt pressure, and layoffs are often well underway. That delay is why economists rely on nowcasting models, which estimate current economic growth using fresh, real-time data instead of historical averages. One of the most watched examples is the Atlanta Fed's GDP Now. In 2025, it showed periods of solid growth, which highlights an important truth about crash detection. Warning systems don't rely on a single number. Strong growth estimates can exist at the same time as rising financial stress and weakening forward-looking indicators. What matters isn't one good reading. It's whether growth begins to slow while other risk signals stay elevated. Crashes rarely come from one bad data point. They come from alignment, where crashes usually begin. Most people imagine economic crises starting when consumers suddenly stop spending. In reality, many crashes begin far from shopping malls and checkout lines. They start in the financial plumbing, where leverage, funding, and asset pricing quietly build pressure. That's why central banks publish financial stability reports focused on balance sheets rather than confidence surveys. When asset prices are stretched, debt is high, and funding depends on calm markets, even small shocks can trigger outsized damage. In 2025, U.S. financial stability assessments pointed to elevated asset valuations and pockets of leverage that could amplify stress if conditions turned. These reports don't predict crashes. They explain how a small problem can spread into a large one. Crashes don't require dramatic triggers. They require fragile systems. When growth is built on borrowing. Another crucial layer of the early warning system tracks credit growth. The Bank for International Settlements focuses on the gap between credit expansion and real economic growth to identify when borrowing becomes excessive. When credit grows much faster than income for long periods, the economy becomes sensitive to interest rates and cash flow disruptions. As soon as conditions tighten, defaults increase, forced selling accelerates, and stress spreads through the system. This indicator doesn't perfectly time recessions, but it has been effective at highlighting periods when downturns become far more dangerous. Debt doesn't cause every crash, but it gives crashes a megaphone. Global stress signals. Modern economies are tightly connected. Energy shocks, trade disruptions, financial volatility, and geopolitical conflict move across borders faster than policymakers can react. That's why institutions like the IMF and World Bank track global growth and downside risks alongside domestic data. In 2025, both institutions warned that global growth was slowing, trade barriers were increasing, and uncertainty remained high. This matters because economies don't need to create their own crisis to suffer one. Stress can be imported. A fragile global environment increases the chance that a shock in one region turns into a problem everywhere. Crashes rarely respect borders. So, does this system really predict crashes? Not exactly. It predicts vulnerability. This system doesn't say, a crash will happen on this date. It says, the conditions that make crashes more likely are increasing. Economic collapses usually follow a familiar sequence. Financial conditions tighten, spending slows, profits weaken, layoffs rise, credit stress spreads, confidence breaks. The warning system tracks each step of that chain. When multiple layers begin flashing at once, history suggests risk is rising, whether people want to hear it or not. If this made you see the economy a little differently, imagine what else is hiding in plain sight. We break down the systems that quietly run the world before they become headlines. If you want more videos like this, like and subscribe so you don't miss what's coming next.